It's time for the Income for Life Daily Dime. Reactions and analysis on important financial news that impacts you in 10 minutes or less. Brought to you by the podcasting pros at Third Wheel Media. If you're a financial professional, estate planning attorney, real estate agent, or any small business owner, Third Wheel Media has a podcasting production package that fits your needs. Visit thirdwheelmedia.com to find out more. Now, here's today's Daily Dime.
Welcome to the Income for Life Daily Dime, powered by Folds of Honor and Third Wheel Media. Our quick hit discussion of the day as we come up with ideas and topics that we feel are important for everyone to have a very quick discussion with Nick and I. And today's discussion that we're going to be talking about, Nick, is a good one because we're going to discuss how we lost all fear in the stock market. So let's have a few minute discussion on this, Nick, because we feel like that there's a lot of people out there that are maybe not in fear of the market, or maybe they're not as concerned with what is going on with the markets right now that we feel it's important enough to have this daily dime about.
I like these, Matt, and I really like these daily dimes in the fact that it's something that you and I are talking about. And since you and I are talking about it, we know that other people are probably thinking about it, so we might as well just record one of these real quick.
Talk about it real quick.
Have the discussion with everybody. And what we were talking about is it seems like everybody out there has kind of thought and lost the normal fear that when stock markets get at all-time highs that they can go back down, and that going back down could actually hurt or have an impact. And when the pandemic hit, the big deal was that the stock market crashed or went down 34, 35%, but how quickly it recovered has maybe masked some of the fear for young investors and even some of us more seasoned investors and you guys out there that are listening that, well, maybe these things will just they'll bounce around and be volatile, but if it shrinks 35%, it'll come back.
It'll come back, and that's what people hear all the time, and that's what they've experienced over the last couple of years. Okay, we had a 35% dip last year, but hey, it recovered inside of a month or 30 days or whatever it was, 90 days, and it bounced back so quickly that people think that's the norm.
Yeah, and it's not the norm.
It is not the norm.
When we started the drop in March of 2020, and it got down to a full 34, 35%, depending on which index you look at, of a dip, people were scared. But then it started the government intervened and everything started to happen. And in 126 trading days, we were back up to the all-time high as it never happened.
And we're still rolling right now.
But the thing that got Matt and I talking about this is anybody that's watching the ticker on the bottom of the screen, today's a Friday and it was going up big today. But 3 or 4 days before this, the 3 days before this, it's been volatile as all get out. The market is looking for, most participants, especially the big institutions, are looking for any signal. Inflation could be creeping, let's sell.
They're all looking for a reason.
The Federal Reserve Chairman says something that is a little bit off kilter, let's sell. The jobs report doesn't come back exactly the way we want it, let's sell. And then we get one thing after 3 or 4 days that turns out rosier than we expected, and we go back up about 4%. That's great that we went back up, but this increased volatility just means that we're getting more towards a normalized structure of these things, and increased volatility can start to hurt.
And one thing that's interesting, Nick, I want to jump in there because we're talking about the big institutions that are doing this. The people that is their job, is to be able to watch this and make money and make all the right decisions. It's not, somebody that is, inside their 401k and making some changes in there. These are the big boys that are making these decisions that are saying, we're looking for a reason.
They're looking for a reason to start to sell. What we're worried about is that us normal investors, us Joe and small town Main Street that have their 401k or just investing, they're the ones that might be getting complacent. They're the ones that might not be as worried as they used to back in 2001, 2008, 2009, where those recessions hurt. Over the last 90 years, we've had 26 recessions. So just counting that as the market dipped 20% or more. On average, it takes 3 years for those dips to recover back to where they were before it started to happen. Typically, it takes decades.
A lot of times, it takes a long time to build that back.
Correct. So we have been, even the last one that we had in 2008, it took almost a half a decade to get back to where we were. if you're retiring or planning for retirement, if the next recessionary event happens and it takes a normal amount of time, 3 to 5 to 10 years, you're on the wrong side of that timeline right
Time
now.
is no longer on your side.
We need to start making sure that our plan is prepared for a market dip, our income is guaranteed, and our investment side that's married along with the income plan is set to prolong increased inflation and market volatility as this goes. We can't just sit idly by and watch the market go up and hope upon hope that it keeps doing what it's done the last 24 months. That's not going to happen forever, and we don't have time on our side as retirees.
And Nick, whenever you and I were discussing today's Daily Dime on this topic, again, have we all lost fear of the stock market? We were talking about how back in March, whenever it dipped 34, 35%.
March of last year.
But it came back so quickly. So many people are now conditioned to think that that's the way that it's going to be moving forward. But what we have learned from 2020 forward is we are in a brand new world of never before sort of economic and financial events. So being able to take that as this is the way it's going to be moving forward is impossible to do, number one.
Correct.
Number two, what you also said is that if you're close to retirement or in retirement right now and you have not made those adjustments to shift like we're advising people to do when they get to be that age, and you get stuck in this dilemma of the market drops and stays down for a long time, it can absolutely devastate you. But there has never been bigger signals to see what's coming, because we were discussing just before we got on the Daily Dime here is that back in 2008, that crash hit like a sledgehammer.
Yes.
and took everybody off guard very quickly. With what's coming right now, everybody knows.
Yes.
And now the big institutions know. They're dying to have a reason to sell. Everybody sees that this is going to happen.
They won't make a movie like they did The Big Short of the 2008-2009 crash, that there was 3 or 4 or 5 firms that made a bunch of money because they were the ones in the know and they made the correct
They were
bets.
the only ones that knew.
They were the only ones that knew. That won't happen this next time. Everybody's
Because
looking,
everybody knows.
everybody's looking ahead. We know that we are not normal. We are overinflated in the stock market. We are overvalued in the stock market. We're overly concentrated in the stock market in a few big tech firms. The overall economy is rebounding. We're starting to come out of the pandemic, but we haven't created any equilibrium in interest rates, in employment, in monetary policy. Any of these things need to work
It's
themselves
so out of
out.
whack.
We need to work itself out. And in that working out, we're going to have increased volatility and increased dips of 5, 10, 15, 20% or more, probably frequently. And if you're planning for retirement, we can't have that happen. We're not trying to be that the sky is falling. We just are saying that you can't be naive because of the recency. You got to have your plan prepared, and your income plan and your investment plan better be locked in lockstep at the hip to make sure that this doesn't happen to you.
It's kind of like the old saying of when you know that this stuff is coming. It's kind of like the old saying of when did Noah build the ark? Before the rain. Well, it's cloudy, and it's going to be raining here pretty quick. Everybody knows it. So only thing that we're asking everybody to take from this quick Daily Dime is understand that a lot of people have lost all this fear in the market where it is very much present. It's just a lot of people don't realize it, but it is right there. So as we wrap up our Daily Dime here, Nick, we're going to be doing these very quick hit conversations as we go along. And we're going to be sending out other Daily Dimes as we go. They're designed to be just a few-minute discussion on a topic that we feel that is very important going on in today's world. And it's something that we feel we want to get out to people quickly and be able to have a quick conversation. So I really enjoy these Daily Dimes that we're going to be doing here at Income for Life. Again, powered by Folds of Honor and our partners at Third Wheel Media.
Hopefully they're helpful. Look forward to it. Have a great day.
This has been the Income for Life Daily Dime. Reactions to and analysis of the important financial news of the day in 10 minutes or less. For help with your financial and retirement plan, call 888-228-8814 or visit incomeforlife.org. The Daily Dime is brought to you by the podcasting pros at Third Wheel Media. Do you need a turnkey solution to launching and maintaining your own podcast? We have packages for business professionals that provide you with content, editing, posting, social media, and all the steps in between. We can make the podcasting process simple and effective. Book a free consultation at thirdwheelmedia.com and mention you heard about us on the Daily Dime for access to an exclusive discount on our services. That's thirdwheelmedia.com. Information provided on today's show is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified professional before taking any action.